Good evening, all the joinees. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. So, meanwhile, others join, let me introduce the topic that we are going to cover for the webinar today. We are going to understand how rolling returns analysis is done, one, on a single fund level, number two, on a portfolio level, and then we can see how we will be doing the same analysis when you compare it with its peers and benchmark, right? So we are going to have an overall look at rolling returns from multiple facets. Next, we will understand what is the utility of using this rolling returns analysis when we are screening mutual funds, or for that matter, its utility in actually coming up with a conclusion on a portfolio, right? Next, we will understand what are the terminologies that are used when you're doing any rolling returns analysis. So on the platform, we have something called as rolling windows, which are very, very important to understand rolling returns analysis. Next comes rolling returns distribution analysis, which is nothing but probability distribution, but on a rolling returns, it works in a slightly different manner. And you can actually understand how you can use this rolling returns distribution to check whether a portfolio or a fund is generating returns in the client's target return range, or for that matter, what is the percentage or what is the probability that a fund meets the client's target return range, and what is the percentage of the same, right? So you can reuse rolling returns distribution analysis for that. Next, we will have a look at portfolio level rolling returns analysis. And then finally, we will throw the forum open for a Q&A session wherein you can get your questions answered by either typing in the chat box or directly unmuting yourself to speak. So let us now begin. So for the purpose of our discussion, we are going to first load in a single fund, right? And we will understand rolling returns on one single fund. We will then move on and build it up on a portfolio level, and then we will compare it with its peers and benchmark. So for that, I'm just going to example load in quant active fund, for an example, right? So I go to the compare section. I'm going to go here in add a fund. I just search for a quant active fund, and it gets added here as a row item. Now, because I want to do rolling returns analysis on a single fund only, what I will do is I'll simply click on this fund. The entire analytics gets open in a new tab. Once we are here, we see the rolling returns analysis tab right here. But first, let's set in a time-bounded range for this analysis. So let's do this rolling returns analysis for the last 5 years. So I go here in start date and I change it to a 5-year period. Now, the entire universe or the data that we are analyzing for this fund is for the last 5 years, 2019 to 2024. Right? Now, let me go on to the rolling returns tab. The first thing that you will see here are some numbers that are written at the top, right? 260, 520, 780. Let's understand what this is. So this is exactly what is rolling windows, meaning this says that if holding period in this particular fund by any investor is a 260 working days, then what are the returns that this fund generates for the investor, right? So the numbers that you can see here denote nothing but the number of days or the holding period that a client or an investor might have in any particular fund or a portfolio. So in this case, everywhere on the platform, 260 is equivalent to 1 year in terms of working days, right? That's why this is called window one. You can, of course, customize this as per your requirement. In this case, we are going to keep it as it is. So 260, 520, and 780, which is typically representing 1 year, 2 year, and 3 year in terms of working days in years, right? And then you see next is these line charts. First, let's turn off the 2-year and the 3-year line charts. How do you turn them off? You simply click on this legend 520 rolling, turn it off like this by clicking on it, right? So 780 days, we're just going to click on it, it will get turned off, right? So now in this case, the blue line over here is a representative of a line chart for the last 260 days, every single period with a holding period of 260 days for the time period under consideration. So in this case, the overall time period that we are considering is a 5 years. But the first data point that will come here in the 260-day rolling window is will be exactly 260 days after the start date. So how do you corroborate that? Just use this mouse pointer to actually zoom into this period by simply clicking on once again by simply clicking on this, and then you'll get to know the first period in this data point. So the first period is a negative 26.33% return, which was clocked in by this particular fund on 1st of April 2020. You see, when I hover on the first pointer here, the date appears at the top. So what does that mean? That means if an investor would have invested in this particular fund exactly 260 days prior to the date that you're seeing here. So exactly 260 days prior to 1st of April 2020 is 2nd of April 2019, which happens to be our start date. And that is the reason this is the first point on the line graph, right? If that was the case, his return from the portfolio would have been a negative 25.09%. Now, as he moves ahead in time, so for an example, if an investor would have invested, let's say, exact 260 days prior to the date that you're seeing here when I hover on the line chart. Now, when I hover, you see the date of 9th of December 2020. Now, if an investor would have invested exactly 260 days prior to this date, the return from this fund that he would have gotten is a 37.23%. Now you will see every point on this line chart will give you some percentage return. If you average the entire return sets out, that gives you an average rolling return from this particular fund, quant active fund, with a 1 year as a time horizon. Why 1 year? Because 260 days. 1 year as a time horizon is a 28.37% return. Right? So this is what is called average rolling return with a 1 year holding period for this particular fund. This is how you interpret rolling returns analysis in the first place. Now let's understand why do you even look at rolling returns analysis. The utility of this is it will tell you, it will average out, right, all the ups and downs that are happening throughout the journey of this particular fund, and it will give you one single number which tells you whether the fund is able to generate consistent returns or not. Right, an average of 28% in a 1 year time period is definitely a good return, if you say. Right. On the other hand, if you also have a look at its lowest return in the last 1 year, if we consider 1 year as the holding period, that happens to be a negative 26.73%. That's the lowest return that was clocked in by this particular fund in 1 year holding period. If you want to see when was this really the case, when was it that the fund gave a negative 26.73%, all you need to do is locate the lowest point on this line chart. So you see the lowest point is this point, which is on 6th of April 2020. Right? The date appears at the top when I hover with the mouse. Right? What does this say? So this says that an investor would have been unluckiest if he would have invested exactly 260 days prior to 6th of April 2020, when the return from this fund would have been negative 26.73%. And that's the lowest in the last, if we consider holding period of 1 year. Now, the beauty of mutual funds and rolling analysis, rolling returns analysis is as you go ahead in time, right? So as your holding period of these mutual funds increase, for an example, as the investor stays invested in this particular fund for a 2 year period. Now for 2 years, what should be relevant is 520 day as the column heading. Now let's simply focus on 520 days by just simply clicking or rather turning this on. So 520 days is represented by the black line chart that you can see. And the average return. So in this case, you are as we increase the period, this is default is absolute. So if you want to see annualized basis, you simply use this drop down and click on annualized. The data are going to change. Right now, let's again turn the other two off, and we see that if we consider 2 years as the holding period, even the lowest return from this fund was a positive 8.98%. Now, what does that mean? So if an investor stays invested for any holding period, which is 2 years, right, then his lowest return is also positive. Right. So in this case, that period is 25th of October 2023. Now, what happened on this date? If the investor would have invested exactly 520 days prior to that date, his return would have been 8.98%. right? So this is what we can figure out on the lower return side. So again, as the holding period further increases to a 3-year period, that is indicated by a 780 days, the lowest return also becomes a double digit number, positive double digit number, from a contrast negative double digit number in a 1-year holding period. So you can definitely highlight this when you're typically suggesting funds for your investors. Now this is on a single fund basis. Let us also understand how you can actually do the same analysis on a portfolio level. So on a portfolio level, all you need to do is you go here into NGEN Markets platform. There's this portfolios tab. When you go on that, let me load in any portfolio. So let me load in this equally weighted portfolio. The moment you click on run, a detailed portfolio analytics runs on a portfolio level. Now, the basis, or rather the parameters, let's keep the same parameters. We are going to change the start date to a 5-year period. So again, we are analyzing 2nd of April 2019 to a 4th of April 2019. Once that is in place, you go to the rolling returns analysis. The entire layout of the page is going to be exactly the same. In this case, the only difference is we are seeing this on a portfolio level, right? So when we say that, okay, an average rolling return is for a 1-year period, that is 260 days, is a 16%. This is for the overall portfolio taken together. Okay. Now, when you're considering rolling returns analysis on a portfolio level, it becomes very, very important to show the client that whether the portfolio that he's possessing actually meets his target return range or not. Right. So for an example, you want to show the client that, okay, this is your portfolio, or for that matter, this is the portfolio that you want to give to the client. Right. Then what you will typically do is you will come down, you'll scroll down and focus on these rolling returns distribution. Here is where you will build in 5 different scenarios. So for an example, you want to tell him that, okay, look, this portfolio that I'm giving you, even if you keep a 1 year as a holding period, that's 260 days, the number of times or the probability of your portfolio generating a negative return is only 5%, right? How do you say that with conviction? So what I've done is I've kept from, which is the starting interval, as negative 12.70, which happens to be the lowest that this portfolio has ever gone in a 1-year holding period for the last 5 years. And the to date or the end range, I've put it as 0. That means all the observations, return numbers between negative 12 to 0 are these, right? So the probability is 5% that your portfolio will give a negative return. Now you can create a series of such intervals. So let's say now conservatively positive, right? Typically a range which is equivalent to savings bank account return. So for that, what we will really do is we'll build a second range, which will be 0.01 immediately next, right? So 0.01 pointer to, let's say, a 4%, right? That's a very, very conservatively, a very, very conservative return of a equivalent to a saving, bank account. So in that case, we see if this is what is the return interval, this portfolio that we have given to the client generates returns 8% of the times in this return range of 4%. Right now, let's go a step ahead and show him that, okay, because this is where you will attract attention of the client, right? So 4.01 to, let's say, again, a conservative target of, or rather conservative return of 8%. Now, typically FT return up to 8%. So you see 4% to 8%, 16% of the times the portfolio backtests in this return interval, right? So 4% to 8%, 16% of the times the portfolio return is in that particular interval. Now, let's move ahead to the next interval, which will typically be his compensation for the extra risk that he takes by investing into markets. Right. So typically, if this is not a very high range, it will not be a very, very comfortable position for the client to actually go in and invest in this portfolio. So what we are now building is 8.01% to, let's say, a fairly good or a moderate return of up to a 25%. So we see 47%. That means in this target return range of 8% to a 25%, the portfolio backtests or portfolio gives return in this range 47% of the times. This is considering only 1 year as the holding period, which is definitely not bad, right? Typically, mutual funds, the longer you stay invested, the returns are definitely going to increase. But in spite of having a 1 year as the holding period, if it generates 47%, between 8% to 25%, that's definitely not a bad proposition. Next, extremely aggressive return expectation, which is beyond 25%, to, of course, a max of a 42.85%. Now, why I'm not changing this highest is because this is where it is getting captured from, right? So highest single year return generated by this portfolio is a 42.85. I'm not keeping that, rather, I'm keeping it unchanged, right? Only the from interval will be 25.01, so that I cover all the observations and I click outside. So it says, if even you have a very, very optimistic and a very aggressive return expectation, in spite of that, your portfolio, or rather the portfolio that you are giving to the client, meets that range 21% of the times. This is the probability, right? These are the probabilities. So 21% of the times you get very, very good return, right? So typically you will sum this two up. So 44% plus a 21%, about 70% of the times, the portfolio will give return between 8% and 42% is the conclusion that you can give in front of the client. Now we have arrived at this conclusion using only rolling returns distribution analysis. And that's the significance of using and understanding these rolling returns distribution. So this was on a portfolio level. Now, so let's summarize. So first we saw on an individual fund level how you can understand rolling returns. Next, we understood on a portfolio level how you can use not just rolling returns, but also rolling returns distributions to arrive at a figure that you can give to the client, which is the portfolio meeting his expectation or his target return expectation. Now, let's move a step ahead and compare a fund with its peer and also with its benchmark and check which is a better performing fund among that category and whether it is beating the benchmark or not. So for that purpose, we have rolling returns analysis at one more place, which is the compare section. So for that, you go to the compare section. We anyway have one fund added here. What we will typically do is we will add in one more fund. So this fund is from multi-cap category. I'm going to add in another multi-cap category fund. Let's say a white oak. White oak multi-cap, I've added that. And again, a relevant benchmark for this category is going to be Nifty multi-cap index. So I'm just going to add in a Nifty multi-cap, Nifty 500 multi-cap index. The moment I click on that, all the three items are now in our compare section main list. There is a separate dedicated tab that we have created for rolling returns analysis, which is this tab, right? You move on to this tab and you see this error that you can see, right? So this is not a mistake, or this is not a thing that you need to be alarmed about. It just says that, look, what you've done is you've added a very, very young fund with a list of a benchmark and of course a older fund, right? So this fund, White Oak Multi-Cap Fund, does not have data for the last 260 days, right? It is only a half year old fund, right? So basically it would have launched somewhere between October or a September of 2023, right? How do you check that? You simply click on this. You will see the start dates right there. So look at that. So it launched 31st October. It started trading typically from 25th of September, right? Therefore, there is no data to fill in the rolling returns number here if you consider 260 days. And that's why there's this NA error. How will you rectify that? So the way of rectifying that is, I mean, you have to put in a rolling window which is lesser than the 260 days. Because when you hover on this question mark, it will typically tell you that the minimum common time period for consideration of the funds that you're analyzing has to be equivalent at least to the rolling window. So in this case, this is a very young fund that we have in this list. So let's take a 6-month analysis. So for 6 months analysis, the equivalent number of days are going to be 130, right? So 260, half of 260 is 130. And that is what we've put in as a rolling window. Now let's put in a time period, which is, let's say, a 3-year time period. So 2021, let's say April to 2024, and you click on run. Now, please note here, you will see dashes. That's because, I mean, the period is not really overlapping. Let's typically consider 120 and let's click on run. We'll have data. One second. Yeah. 1 second. This is where it starts. Okay, fine. Let's analyze the fund with its benchmark. Let's, for the time being, ignore white oak. When we remove that, you go to rolling returns. It will generate returns. So let's again consider a rolling window of 130. That's half a year, and then let's put in a time period again, 2021 onwards. And you click on run. So the point is, what I was trying to come at is whenever you put in a period that is less than a year, right? What you should typically be focusing on is the methodology, right? If you want to see actual 6-month time period, then you should be choosing the methodology as absolute, right? Because it's a period that's less than a year. If you want to annualize this and actually extrapolate this to a 1-year period from 130 days, then you should be choosing in absolute or rather annualized. But in this case, the actual returns would be absolute return, which will be relevant, right? The moment you click on run, it will give you the data. So in this case, the blue line is representative of quant active fund, and Nifty 500, which is a benchmark, is represented by the black line over here. Now, there are a couple of more data points that are visible in the compare section, which is the range and the percentage positive. So let's understand these two data points here. So the range typically is a difference, or rather it's the swing that it shows between the as high as it can go versus as low as it can go. So in this case, if you just sum this up, take a modular sum of this, right? 34.39% plus a 11.78% is the swing between the highest and the lowest return that is generated by this quant active fund, which is a 46.17. So this is the swing that is there in the returns of this particular fund versus on in the case of benchmark, it is 44%. Now let's understand what this percentage positive means. So if we consider there are only two quadrants, right? One is positive, that's above zero, and one is negative, that's below zero. Then it will show that, okay, if what is the percentage that my fund gives in the positive quadrant. In this case, if I consider 6 months as the holding period, 75% of the times quant active fund has actually given in even a 6-month return in the positive quadrant. That's above zero. On the other hand, if I replicate this logic for the benchmark, it is given in the positive quadrant, that's above zero, only 73% of the times. So in this case, if you were to typically choose between an index fund which tracks in a Nifty 500 multi-cap, right, versus a actively managed fund, which is a quant active fund, you would typically say that, okay, percentage positive, even for a conservative investor, it generates higher percentage of returns in the positive quadrant. Now, of course, please note, this is for a 6-month period, that is 130 days. The moment you increase this to a 260, or for that matter, higher number of holding days, the percentage positive is going to change. So for an example, let's check this on a 260-day period, that is 1 year, right? You click on run. You see percentage positive has changed. It has started going closer to 100. 96% of the times, in 1 year periods between 2021 to 2024, this fund has given in the positive quadrant. On the other hand, as we increase the period further to a 520-day period, or for that matter, a 730 days period, which is 3 years, we click on run, we see 100% of the times, all the observations are in the positive quadrant, right? So that means the longer you hold, the percentage positive goes on increasing and ultimately becomes positive. So this is the use case scenario that you can use using this range and percentage positive. Now, let's understand this rolling returns distribution, the logic with which these numbers are getting calculated, right? So these do not happen randomly. There's a logic that runs behind that. So for that matter, let me just remove this index from here. And I'm going to go to rolling returns again, distribution. I'm going to put in 260 as the rolling window. Start date could be 1st of April, 5 years analysis, what we are doing. So let's say 1st of April. And then I click on annualize and click on run. Okay. So the numbers that you see here are a representative of the slots that are that are coming in. So there's an export option. The moment you click on export, something like this will get exported, right? So this is the rolling returns analysis that we are doing on this particular fund. So quant active fund, this is the ranges under consideration. This is the first interval. This is the second interval. This is the third interval, fourth, and the fifth. Once this is through, you see these are the probabilities that had gotten exported. Now let's understand on what basis are these negative 4.70 to 5.14 arrived, right? If you simply take the summation of the worst return, that means negative 4.70 to maximum positive return, that's 44.50%. If you take a overall sum of that, that comes to a 49.2%. How do you arrive at that? So 44.5 plus a 4.7. So that's how you come at the total range that's under consideration. So that's we are considering 49% as the overall range. In that overall range, how many are the number of intervals that we are considering? So in this case, we are considering 5 intervals, 1, 2, 3, 4, and 5. So you divide this 49.2 by a 5. That's number of intervals under consideration. The moment you divide it by 5, you get the size that will be for every interval. It has to be an equally sized interval. And that is exactly what has happened here. So 9.84 is the size of every interval. These are equally sized interval. So how will you check that? So you simply do a simple check. So you take the lowest level, or rather the lower class interval of any range. So for an example, let's take 5.14, right? Which is the lower interval of the second range. You add the size of the interval, that's 9.84% to this 5.14. And what should be the resultant should be the upper range of the same interval, right? So 5.14 was the lower range. We are adding the size of the interval to that range, and we arrive at the upper range of the same interval, right? So this is what 14.98 should be the top end. That's the upper class, right? Similarly, what is going to be automatically populated is the lowest, that's negative 4.70, and the highest, that's 44.50. After that, the ranges are going to be dependent on the size of the interval. Once this is arrived, it will show in the probabilities, which is ultimately the result, what you can see on the platform. Once these results are arrived, in order to calculate the weighted average probabilities that appear on the platform, which typically tell you on an average, considering all the return intervals with equal return size, what is the average weighted average probability return generated by this particular fund, or for that matter, any particular portfolio. So for that, the methodology is you calculate midpoints of each of the intervals. Now, how will you calculate midpoints? Consider negative 4.70 and 5.14, right? And divided it by 2. That's how you arrive at the midpoints. And that's the exact formula that is used here. For an example, 10.06. So that's a midpoint of 5.14% and a 14.98%. 10.06 is the midpoint of this particular range. Once you've arrived at the midpoints of each of the ranges, you simply calculate the probability or the weighted average probability of every interval, right? By multiplying this midpoint and the probability of that particular interval. So you multiply 0.22 by a 7.92, which is the probability of that interval. So you multiply that, you replicate this for all the columns. So I'm just going to drag it like that. And this is typically multiplication of 39.58 multiplied by 18.11. Once this is in place, now this 19.64 is simply the summation of all of these individual class interval weighted average probabilities. So for that, I simply go here. I take a sum function. And that is how we arrive at this weighted average probability return. 19.64. So on an average, we can say that in this 260-day rolling returns distribution that we were analyzing, the average return of quant active fund is a 19.64%, right? So this is what can be replicated not just on a fund, but also on a portfolio. I've replicated, rather shown this for a fund. You could replicate that on a portfolio level as well. These are all the underlying calculations that go in to calculate rolling returns analysis, typically rolling returns distribution. That was typically about it from my side for the product related webinar. If you have any questions, please feel free to either unmute yourself and ask or typing in chat box. Oh, yeah, I must have missed the start date, is it? The start date was different. Um, there's a message in the chat box. Start date 23/4/2023. Uh, yeah, so basically whenever you're taking Excel exports, you need to ensure that the start dates that you've taken for the analysis are matching. Only then the data will match, right? So in this case, uh, I think we'd considered September. Okay, so there is a message in the chat box which says, explain something about volatility. Okay, the volatility, first of all, the basic standard deviation or the regular measure of risk that appears right here in the main list, right? When you go to the main list, we see the standard deviation, which is simply a measure of risk or volatility of that particular fund and its returns over time, right? On the other hand, what you see here in the rolling returns tab, the vol number, vol number here is a double standard deviation, meaning this is the volatility of the rolling returns time series or the price series that you have. So this is like a double standard deviation of the return. So this volatility, rolling returns volatility and standard deviations are not the same and they are never going to match because this simply is like a double standard deviation. This typically shows how volatile are these rolling returns, right? So for an example, this 260 days returns, these were the time series or these were the points that were arrived at by calculating, right? This volatility says that how each point is different from its average. This is what is the volatility on a rolling returns basis. Okay, so there's a question in the chat box which says, where did the return range come from in the last Excel sheet? So yeah, so basically what I had done is I had taken a 3-year time period, and you see this were the return ranges, and I took an export of this. So considering 3 years as the time period, considering 260 days as the rolling window, and you simply take an Excel export of this. You will see the lowest is 4.70, which is appearing here, right? 4.70. So this is what was taken to explain rolling returns distribution previously. But of course, the same logic stays for any other period that you analyze. Let's say now we want to do, for this particular periods, right? So you simply download this. It gets downloaded in an Excel sheet. So simply load that up, and that's how that will be visible. These are the ranges. Yeah. So the lowest is getting picked up from this, right? Quant active fund lowest return in the last 3 years is considering, of course, 260 days as the rolling window, is negative 4.70. That is exactly what is getting popped up here also, negative 4.70. The highest maximum positive is 44.50. That's coming in from here, 44.50 highest. And what I showed in the webinar is the logic as to how you derive these, right? How are these calculated? There's an underlying logic that goes behind it. These are 5 intervals. So how do you come at the sizes of each of these intervals? You take 44.50 plus 4.70. That comes to a 49, total of 49. And then you divide that by 5. That is your size of every interval, right? And then you multiply this by the midpoints and you arrive at the weighted average probability. There's another question in the chat box which says, what about risk-adjusted returns? Will the software give that? Yes, definitely. For risk-adjusted returns, we have two ratios. One is Sharpe ratio and the other one is Sortino. So for that, you have to come here in the main list. The moment you come in the main list, you will see Sharpe ratio appearing here. It's just that in order to ensure that you're comparing or actually seeing the right ratios, you need to ensure this the start date is what you're changing. So this Sharpe ratio is since inception of this particular fund, quant active fund. But let's say now you want to see Sharpe ratios for the last 3 years, right? You click on this settings wheel. You say that, okay, 3 years is what my period under consideration is. So you say 2021 and you put 1st of April and then you click on go. The moment you do that, you'll see that, okay, there's an exclamation mark which says it's a custom start date that you've put. And then the Sharpe ratio of 1.08 is the Sharpe ratio for the last 3 years. Sharpe ratio is typically risk-adjusted returns, so the returns that a fund generates per unit of risk that it takes. The numerator.
Sorry, just to add here, Prajakta, if you can also show that the rolling analysis tab here, the same way that you can plot rolling returns, you can plot rolling volatility, you can also plot risk-adjusted returns here. So that's basically the return divided by the vol. So you can actually see risk-adjusted returns over time for a number of funds in one place. There's a question saying, what's the difference between risk-adjusted and rolling return? Well, rolling is a way we are looking at returns, because what rolling means, whether you're doing the rolling of returns or volatility or risk-adjusted returns, this is basically showing you all the 260-day periods in the past. So we're looking at over 10 years, and obviously the 10-year period is made up of smaller periods of, let's say, 1 year. So from 1st Jan to 1st Jan of next year, 2nd Jan to 2nd Jan, 3rd Jan to 3rd Jan, and so on. So all of the 1-year periods are represented by this chart. And when we say the periods are represented, you can either calculate the return during that 1-year period, you can calculate the volatility, or you can calculate the risk-adjusted return that you can choose on the drop down on the top. But every point on this chart is showing you the 1-year return, volatility, or risk-adjusted return for that 1-year period, and then the next period on from there. So rolling gives you a good idea, is a much better way to actually look at historical performance, because if you just look at return over the last 10 years, you get the return for 10 years ago to now. What this gives you is a much more in-depth view of what has happened in the past. And especially if your holding period is 1 year, you might want to look at what kind of performance you've got for a 1-year period over the last 10 years. And this is showing all of the 1-year periods over the last 10 years. Any other questions, please let us know. There's another question on the chat asking about the portfolio return. So it's not exactly what you've written here. So we don't look at the average return of each fund historically. We actually go back in time and then calculate the returns as we go through time based on their historical holdings, using various different rebalancing methods. Now here, if you want to look at individual fund returns, you can definitely do a comparison. So this compare section that we were looking at, there you can load up in your main list all the funds that are in your portfolio. There are various different ways of doing it. So for example, if you go to the portfolio, there's a compare button on top of that. And as soon as you click it, it will add all the funds from that portfolio into this list. Once it's done that, then you can see all of the statistics, many different statistics throughout these tabs for this list. And you can basically do a comparative analysis for all the funds in your portfolio in one place. So as you can see, there are many tabs. We were actually today just talking about one specific tab here, the rolling returns tab, but there's many others also. And they will all focus on these funds that you have loaded in the comparison section. Any other questions, please let us know. Okay, if there's nothing else, we can close for today.
Yes, sir. So thank you everyone for joining in. Just adding on to the question that was asked, where did the Excel export come in? The one that we were discussing, right? So when I had created the simulation, I had typically taken 2 year period, right? So when you take a 2 year period, start date was 1st of April 2022, end date was 4th of April 2024, rolling window of 260. So we see average return is 19.84%, and these were the return intervals. I just simply took an Excel report, and this is how it looked, right? Which exactly matches, right? So 19.64. So start date was a 2 year period. During the webinar, I took a 5 year period. Therefore, there was a goof up. But when you take a 2 year period, or rather take a export live, you will see the data matching, right? So this is what I had taken when I had built this Excel sheet. Thank you everyone again for joining in. You can definitely refer to the recordings of our past webinar sessions on our YouTube channel. You will see a dedicated list that is created for past webinar recordings. Already 102 plus videos uploaded. You will even see this video uploaded in the next week's time. Till then, do stay tuned and have a great weekend ahead. Thank you so much.